If you've been trading any more than a day, you would know this rule. Always trade with the trend. If we put every aspect of technical analysis aside for the moment and focus on this one thing, and that is the direction of the trend or the market. Fortunately, this is a relatively easy thing to do. After all, your first consideration is to pick which side of the market that you want to take. As we all know, there are three types of trends: uptrends, downtrends, and ranging markets. Making this rule work for you requires the willingness to identify what's already happening in the market and simply assume that it will continue at least for the duration of at least one trade. No matter which trend you choose to trade, the common sense psychology behind this rule is don't argue with the market. As a trader looking for long-term success, one important discipline to learn is the market is always right. The market will clearly show you what the prevailing trend is, and taking money from the market, no matter which trend is evident, does not require a lot of effort or study. It does require a discipline. Once you've taken a position in line with the prevailing trend, then there's really nothing much more to do except manage the trade, lock in profits as that's playing out, and add to your existing position until the trend is over. So let's discuss each trend individually. Firstly, an uptrend. In my view, the uptrend is the most difficult to trade successfully. All uptrends are aberrations and are exploited by professional traders as a short-term shorting opportunity. The more convinced a typical trader is that the bull market is underway, the better the short selling opportunity is for the professional. In my view, if you intend to trade to be long in the market in a developing uptrend, that should be treated as a short-term position. Bull markets attract a lot of noise and people who typically would never be in the market. Bull markets are exhaustive by nature and are often subject to maniacs, panics, and non-professional traders much more than other trends. I'm of the opinion the best approach when trading an uptrend is to take the point of view that it could all be over tomorrow. Bull markets make me very, very nervous. You need to be hyper vigilant if you're going to take a long position, in my view. Let's have a look at downtrends. In my view, trading the downtrend is the most secure and profitable way to grow your account balance. Once selling pressure kicks in the market, that market can go, and often does, a long way for a long time. Contrary to an uptrend, bear markets need very little to keep them going. Hence the old phrase, a bull needs to eat each day, a bear needs to eat only once in a while. A downtrend always follows an uptrend. It's the nature of the zero-sum transaction markets that make any bull market will be followed by an equal or greater bear market. It's only a matter of time. And if you're prepared properly, you will make an absolute fortune trading the short side if you remain disciplined and add to your positions as your trades are playing out in your favor. Rangebound markets, on the other hand, is the easiest money available to you. There's lower risk in being too early on the buy side or the sell side, which can occur quite often when the market is in an uptrend or a downtrend. In range-bound markets, guys, the buying and selling points are already predetermined for you. The only real question is whether the range is over the moment you want to execute a trade, one side or the other. In my view, range-bound markets should be viewed, again, as a short-term opportunity, ranging from several hours to several weeks. Once a range is established, there's a very low risk of a breakout for usually 2 or 3 solid attempts of hits from the buy side or the sell side of the range. Now, of course, developing a solid trading method is all about fitting your personal approach to whatever trend you are most comfortable with trading. As a matter of fact, for me, after 14 years of journaling my trades, the best results have always been shorting the market in a downtrend or taking the sell side of a range-bound market. Let's have a look at some examples of an uptrend versus a downtrend. Okay, trades, let's have a look at the difference between an uptrend and a downtrend. As I said earlier, if I had a opportunity to take a long position or an opportunity to take a short position, I would take the short position over the long position every day of the week. Now, we'll look at some examples of this, and it's a good example of how much energy, if you like, is required for price to keep on moving up as opposed to price selling off. Now, this is not anomaly. This happens on every market, regardless of what you're trading. Every market operates the same way. So this is just a Forex pair looking at right now. This is the British pound, Australian dollar, but it's a classic example, and you'll find these on every chart. And I encourage you to back test this to prove this for yourself of how long it takes price to rise as opposed for price to sell off. So in the British pound, Australian dollar, here's where the uptrend commenced. This is in January 2021. We can see price made its way up, pull back, continued the uptrend until it rejoined its resistance here. That was exactly 1 year. This was January 2022. And then we can see very clearly, look how long it took. January 2022, 4 months later, price went lower than the beginning of the uptrend. What took 1 year was all wiped out within 4 months in a downtrend. Now, again, this is not an anomaly. This happens on every market. Downtrends are your friend. And then we can see price consolidated for a while before breaking out of this consolidation, this range-bound market. And if we were to go even further, we can see where price ended up before the uptrend resumed. All the way down here, this 159,133 area. In fact, this was almost twice, this move here, twice the size of the uptrend move. The uptrend was about 1,700 pips, roughly, and this was pretty close to 3,300 pips to the downside, and that took 9 months. So we have a 4-month move in the downtrend to completely wipe out what took a year in an uptrend. I view it as uptrends are like taking the stairs up, a downtrend is like taking the elevator down. Far less energy are required for price to move down. So wiped out 12 years of uptrend in 4 months. Then it made twice the move of the uptrend on the short side after 9 months. A very simple but classic example of why, in my view, downtrends are your friend. You will make far more money shorting a market than you ever will in going long. Not saying you can't go long, of course, but you need to be hyper vigilant, as I said, in going long, and have the view that uptrends could end tomorrow and a downtrend commences. And as I said earlier, once it gets that momentum or that selling pressure, well, then there's no end to how low this thing can go and how fast it can drop. There's an old saying, don't try and catch a falling knife, just let it drop. So always, guys, if you have the opportunity to go long or short, let's say you have an equal opportunity, then I would highly encourage you to take the short side of the market and let that market drop for longer. Hold that trade for longer than you'd probably like. You'd be surprised how far downtrends go compared to uptrends. Anyway, let's have a look at other markets. This is just a one currency pair. Let's have a look at this dynamic, the market dynamics in other markets. Thank you, traders. Okay, traders, let's have a look at an example on silver. Silver had been in a slow grinding uptrend since January 24 before reaching this high, and then a very significant sell-off with the uptrend resuming in June 26. And then it took June 26 up here. That's the end of the uptrend. That's at October 28. October 28. 1 year and 9 months uptrend from here to there. And then it took 7 months in the downtrend to wipe out all this bullish movement, this bullish trend. So 1 year and 9 months to get there, 7 months to wipe it all out. Again, this is not an anomaly. All markets act this way. Doesn't matter what markets you trade, whether it be commodities, indices, forex, it's irrelevant. They all act in this manner. So again, you can see a classic example of how fast or how less energy it takes for price to drop as it does to slowly grind its way upwards during the uptrend. So guys, once again, if I had the opportunity, now you'd make money in the uptrend and the downtrend, but you make more money faster going short than you ever will going long. Traders, just to finish off, we'll finish off on an indice. This is the NASDAQ. Once again, a long sustained uptrend. We can see support through here. Price rotated back down, rejoined support, and then a 6-month uptrend until price reached this resistance area, and then it took 2 months for the sellers to come in and wipe out what took the buyers 6 months to achieve, if I can put it that way. So again, just another clear example of how long it takes for price to continue to rise and how fast it takes for price to fall. So I guess the underlying premise, and you've noticed by now, is the downtrend is your friend. I said it before. If I had the opportunity to take either side of the market, I would always take a downtrend over an uptrend. Anyway, guys, I do hope you've got something out of this video training, this YouTube video, around the characteristics of the 3 types of trend. In the next video I'll do, I'm creating a video explaining more about downtrends, and of course I'll let you know when that is posted. Thank you, traders. Bye for now.